Maripel Opariado, and I'm a tutor for corporate financial analysis. In that session, we'll be dealing with analysis and interpretation. Of this course, you should be able to differentiate between analysis and interpretation, as well as explain the three various types of analysis. Now, the relevance of financial statements is not just in their preparation, but rather in your ability to analyze and interpret them. And the end goal of financial analysis, like we said, is to enable users of financial information make informed financial and economic decisions, as well as investment decisions. So your ability to understand and smartly present information in a way that helps interested parties to make wise judgments and informed decisions is the basis of analysis and interpretations of financial statements. Now, what exactly is analysis? So by analysis, we refer to the proper arrangement and classification of data that is being given in the financial statements. So you'd realize that in the way that financial statements are prepared, there would be the urgency or the need for you to regroup the data into distinct parts, reclassify them based on some specific conditions, and present them in the simplest and most understandable form. Now, in conducting analysis studies, you know that you are trying to find relationships or identify trends among different financial data in order to come out with the strengths and weaknesses of the firm or the company. And that's what analysis is all about. Now, interpretation is more of an art than a science, in the sense that it's not a pre-formatted way of going about it. However, you have to undertake a number of actions. You have to arrange, you have to analyze, and you have to establish connections between the financial data that you have simplified in order for you to draw conclusions. So interpretation is simply you giving meaning and significance or relevance to the data you have simplified, and that is what interpretation is about. So with interpretation, you would want to do some comparison, you'd want to compare and contrast, you'd want to assess the components in order to draw conclusions about how efficient the firm or the operations of the firm are. You want to determine or draw conclusions about the financial soundness of the firm, about the liquidity position, and even the profitability of the firm. And that's the aim of interpretation. You are giving relevance to that data you have simplified and how significant it is to inform the decisions of users. Now, analysis and interpretation are sometimes used interchangeably, and most of the time, analysis is used to imply both interpretation and analysis. Now, you should know that you cannot interpret any financial information if you have not first analyzed it. Therefore, analysis is done to reclassify and rearrange the financial statements in order to establish connections. And interpretation is done to draw conclusions on the rearranged and the reclassified financial information that you have made or you have simplified in order to supply information to interested parties. So in other words, without interpretation, analysis is useless. So you can do all the reclassification and simplification. However, if you're not able to draw conclusions based on those information that you have simplified, then interpretation is useless. However, you should note that you cannot interpret data that you have not analyzed. Therefore, analysis is always followed by interpretation. So there are various types of analysis, and in this, they can be grouped according to three separate or distinct parts. First, analysis can be grouped into or according to material use. Secondly, according to methods of operation. And thirdly, according to objectives. Now we'll take each of the various classifications and explain them. So analysis according to material use. Under this type of financial analysis, we have two folds. One, the first one is the external analysis, and the second is the internal analysis. So the external analysis are made by persons who are not related to the accounting records of the firm. However, those people are interested or they rely on published financial statements in order to make informed decisions. So usually external analysis are conducted or undertaken by government agencies, by banks, by prospective investors, and all those external stakeholders. Internal analysis, on the other hand, are made by persons who are associated with the accounting reports of the firm. So it could be done by members of the company, by the board of directors, or by the managers in order to assess their efficiency or any other objective or goal of the firm that they wish to assess. Now, besides material use, there is analysis according to methods of operations or modus operandi. Now, in this type of financial analysis, we have the horizontal analysis and the vertical analysis. And the horizontal analysis is when the financial statements of 1 year of a specific company is analyzed, interpreted, and compared to the financial statements of other years. So it could be prior years. So you could have a horizontal analysis for Nestle Ghana Limited for a series of years, let's say from 2015 to 2022, and that would be horizontal analysis. Vertical analysis, on the other hand, is when financial statements for a company for a particular period is analyzed, where items in the, let's say, the income statement are expressed in terms of sales of the company, and the items of the statement of financial position are expressed in terms of the assets of the company. So you could have let's say for the statements of financial position, you could have the assets, the current assets of the firm. Each item being expressed has or be expressed in terms of the assets of the firm. So you could have liabilities being expressed in terms of the assets of the firm. Sales, pardon me, not sales. You could have inventory being expressed in terms of the assets of the firm, or cash in hand or cash at bank, or you could have debtors or trade receivables being expressed in terms of the assets of the company. Also, analysis according to objectives, and this may be short-term analysis or long-term analysis. The short-term analysis is done to study the current financial stability, profitability, and solvency of a firm, which helps in evaluating the working capital of the firm. By working capital, I mean the difference between current assets and current liabilities. Long-term analysis, on the other hand, has to suggest is a study of the long-term financial stability, solvency, and profitability of a firm, and is to assist in long-term planning and determining the survival of the firm. So, limitations of analysis and interpretation. Although analysis and interpretations are very relevant in making informed decisions, it has its own limitations. One, it is difficult to decide on the proper basis of comparison, so as to whether you should use which type of analysis, whether the short-term or long-term, or whether the horizontal or vertical. So there's no clear proper basis for making comparison, and that's difficult to decide on. Also, comparison is difficult due to differences in the situation of two companies or of one company over the years. So in our earlier sessions, we discussed that there are a number of factors that can affect analysis. And in analyzing a company, you'd have to consider the economic situations or conditions in which the firm is operating in, as well as the industrial conditions. And so it may be difficult due to differences in, let's say, economic conditions over a number of years, in case you want to do a horizontal analysis. And also, if you have to compare two companies, they may have different situations or different circumstances surrounding their operations, and therefore it would make comparison difficult. Also, conclusions from them may be invalid if price level changes. So there are a number of changes, like we mentioned earlier, or other factors, including inflation, that may affect it. And since accounting is based on historical data, if you want to make any forecast or future planning purposes, if there are price changes, any conclusions you draw using historical data from financial statements might be invalid and therefore lead to faulty or inefficient decisions. Also, historical financial statements are no indicators of the future, and that is one limitation of analysis. And so in this session we discussed the differences and similarities between analysis and interpretation. The word analysis, we said, can be used to imply both analysis and interpretation. However, interpretation cannot be done without analysis, and analysis without interpretation is basically useless. We also further explained that analysis can be done according to material use, according to method of operation, and according to objectives. So according to material use, you could have analysis being done internally or external, for internal purposes or external purposes. According to methods of operation, it could be horizontal or vertical analysis, and according to objectives, it could be for long term or the short term. We also outline several limitations of analysis.